Welcome back to the stream. In today's video we're going to talk about instruments that enable us to access the forex markets, especially candlesticks. We'll talk about the instruments that allow us to be able to know price data, the history of price. Let me write in full. Going to learn about candlesticks, price data, historical and present, and also we'll have to talk about how historical data can enable us to predict price movements. To predict price movements in the future. Okay, great. So these are the topics we are going to cover today. Firstly, the candlesticks, price data, historical and present, and how historical data can help us to predict price movements in the future. So to start things off, in order to access the forex markets, we have to use certain instruments. Just like if you want to drive a car but you don't have fuel, you need tires, you need battery, you need a speedometer, you need pretty much everything that you need in order for a car to start moving. So similarly, in the forex market, we need some instruments in order to access the forex market, in order to smartly gamble with our money in the forex market. But it is not exactly gambling, because in the forex market we have things like risk management, which can enable you to be able to only lose the amount you're willing to lose, unlike gambling whereby your total stake will always be your total loss should things not go your way. So in the forex market, we have about 3 instruments that show us price data. The most common one being the Japanese candlestick. So we have the Japanese candlesticks as most common. Japanese candlesticks are the most common instruments used in order to show us price data in the forex charts. Secondly, we have line charts, which have also been used in history and today in order to show us price data. And thirdly, we have bar charts. Bar charts are also used to show us price data in the forex market, what is happening, how things are being bought, where they are being bought, if things are being sold, where is this thing getting sold at, what price, what level, what's the psychology behind the sell-off, or what's the psychology behind the rally being when prices go up and the sell-off being when prices go down. So these are the 3 instruments we use in order to show price. The Japanese candlesticks, which are commonly used, like mostly used in fact, and then we have line charts, which are used as well, and thirdly the bar charts. So Now that we've talked about both Japanese candlesticks, line charts, and bar charts being used in forex in order to show us price and movement, now let us get into the first one, being the Japanese candlesticks. Okay, so for the Japanese candlesticks, they were designed in Japan, of course, by the Japanese in order to show how price movements are. And if we can draw our chart here, let's say we have price moving from point 1, we have point 2 on the axis here, we have point 3. So now we have price moving. This is how a Japanese candlestick would look like. It's something like this in the charts. A Japanese candlestick. Yes, it looks like a candle because it's a candlestick. So okay, let me not even do it on the. So we have different types of candlesticks, but the basic foundation of a candlestick is that it has a body. It has a body that looks like this. It has a rectangular body that looks like this, and it has something like this. These two little black lines here are called wicks. We call them wicks. So this rectangular box here, it's a candlestick body, so we can just name it the body of a candlestick. The Japanese decided to do it this way in order to provide us with simple representation of how price looks like, but I will further get into detail of how the body becomes to be the body. And this two lines up here, these are the wicks. We call them wicks. Call them wicks. And this one is a wick also. So the candlestick, what it does is to show us where price opens and where price closes. So if we have a market that is going upwards in an upward direction market, remember we're still going to get to market data and all, but it's important to also start here. So if the market is going up, a candlestick that corresponds with a market that is going up will often be seen by having a green body. So we have color for this. We have color also for candlesticks. So a candlestick that represents a market that is going up will often have a green body. Green, it symbolizes a market that goes up. And if the market is going down, we are going to have a candlestick. Let me draw a similar candlestick here. We're going to have a candlestick that has a red body. Yes, the body is shaded red. Okay, I'm sorry for the terrible drawing there, but I hope you get the picture. But basically the body will have to be red if the candlestick. Okay, I give up. Okay. So we have two types of markets: a market that is going up and a market that is going down. The market that is going up can be seen by green body if we're talking about candlesticks, and the market that is going down, we can see that by the red bodies. So let me do this quick search. Bullish candlestick. Okay, so if we come here, you see on this side, yes, this is the color of a candlestick that tells us that the market is going up, and red color shows us the body of a candlestick that is going that shows a market that is going down. So let me make this. So let us have a better drawing tools. Okay, so this is how a candlestick will look like if this candlestick shows appreciation in the market, and if this candlestick shows depreciation or loss of strength, its color will be red. So if we're saying we have two types of candlesticks, a candlestick that shows upward movement and a candlestick that shows downward movement, the next thing to discuss is to where prices are at, where we find the price. What's the price? What's happening here? If you're saying this candlestick shows upward movement or appreciation of value, and this one shows depreciation of value or downward movement, so how do we see price? Well, first of all, a candlestick opens down here. If we are talking about a candlestick that says that the market is going to go up, this level down here is where the candlestick opens at a certain price. So let's say this candlestick opens at 15 rand. So if we have 15 rand as our opening price for the currency pair of maybe US dollar against the South African rand, if the current price is 15 rand, that will just turn into a straight line right here before we have the green body. So at this opening price, which is like the genesis of price, if we call it the beginning and all, so at this starting point of price, the market will open at this level, and if the dollar will get more expensive than the rand in the coming hours, minutes, or days, if the dollar price goes up against the South African rand, the candlestick will start going up. So it's something like this. Let's do this. So this is the line we have where the price opens, okay, and it is 15 rands. So if we have 15 rands as a straight black line where the price opens, and during the day the price of this instrument that we're talking about goes up, which means that if you're talking about the US dollar against the South African rand, which has its symbol as ZAR, if we're talking about the US dollar against the ZAR, and this is the opening price for that day, 15 rands, and the price opens here, and certain events take place. Remember, when you're talking about forex, in the previous videos we discussed that there are certain factors that leads to price changes, such as the meetings in the government, interest rates decisions, what the bank does, what the bank doesn't do. So all those factors lead to one currency appreciating against the other one, so, or appreciating or depreciating, either way. So if we have the first price as 15 rands, if the US dollar gains strength, we'll start to see the candlestick being formed, and we'll see upward movement. At this point, let's say now we have moved from 15 rands to 15.2 at this level. The price opened here, it hasn't closed yet because we are still events are still happening during the day. We'll get to times when a candlestick will close, the time when it opens, depending on what kind of a candlestick it is, because we have time frames for these candlesticks. Some candlesticks are candlesticks that are formed in 30 minutes, an hour, 2 hours or more. So we'll get to times when candlesticks form and times when candlesticks close. But generally, if a candlestick opens at a certain price and the market for that candlestick says that we have appreciation or we're going up, it will turn green as it goes up, So if it goes up from this level to the 15.2 level, or goes even further, like if we continue with this upward movement, the candlestick will continue getting bigger and bigger. But if it gets to this level, let's say this is the level that it stops going up at, and it's, let's say, is 15.9. so if this candlestick at 15.9 stops going up before it closes, then this will be the last point where the market touches before it goes down, if it will have any influencing factors that may lead it to going down. So if this will be the last price for it to go down, we are going to see something like this. Okay, if this was the last place for it to go up, it is going to leave what we call a wick or a shadow, simply representing the last place it was seen at before the bullish movement or the appreciation movement started to decline. So remember, at one point this candlestick was all green up to the level of 15.9, but when it got to the level of 15.9, that's where it started losing value. So the moment a candlestick goes up and gets to a certain point, and from that point starts going down, showing loss of value, it leaves a wick, representing that once upon a time it was up here. So as a trader, when you see a candlestick leaving a wick, you know that at some point this candlestick was all green. It was all green because it was here, but after a while it retraced backwards, or it went downwards, meaning that it couldn't keep going up forever and ever, so it started going down. So if at the time of its expiry, because like I said, candlesticks are formed based on time. We have candlesticks that form per minute, meaning every minute we have a candlestick being formed, and we have candlesticks that form every 5 minutes. So this means that every 5 minutes a candlestick is being formed, and you have candlesticks that are formed every 15 minutes, every hour, every 4 hours, every day, 1 day. We have candlesticks that form every day, meaning per day we have one candlestick that represents the entire price movement of the entire price movement for that day will be shown by just one candlestick. But for 1 minute, it means that every minute we get a candlestick that shows price movement, meaning at this minute we have a candlestick that will form, and after 60 seconds we'll have another candlestick form, and after another 60 seconds another candlestick will form. For every 5 minutes at this level, we are saying that we are going to count from 1 minute to the 5th minute for one candlestick to form. So one candlestick here will take 5 minutes to open at a price and close at another price. And from the beginning of from the 6th minute to the 10th minute, we'll have another candlestick form. Okay, and with the 15 minutes candlestick, this means that every 15 minutes we get a candlestick. After 15 minutes, a candlestick. 15 minutes later, a candlestick. For an hour, it takes an entire hour to create a candlestick. Another hour to create a candlestick. 4 hours. Similarly, we are saying that on this time frame we are going to see one candlestick being formed for 4 whole hours. And for 1 day time frame, we are saying that it is going to take an entire day, 24 hours, for one candlestick to be formed. Whether it will be a green or a red candlestick, but the duration it will take will be an entire day for it to be fully formed. Okay, so let us go back to the anatomy of a candlestick, how it closes and how it opens. So for a candlestick that will open and appreciate it in price, that candlestick will open at a certain level, which we can say it is the lowest level for a candlestick that is going to appreciate, and by the time the expiry date comes in, it will close at its highest. So if this candlestick, let's say it is a candlestick that forms during a minute, so if we're looking at a 1 minute time frame, okay, we have 1 minute time frame, meaning that every single minute we are getting a candlestick, and you are looking at that time frame. I will show you the different time frames, you will see them, don't worry about that, but let us go through this one. So if we're saying that every single minute we're getting a new candlestick, and it opens at this price, appreciates in value, and on the 59th second it closes here. And if it has left this black line here, it means that once upon a time, where was this candlestick? It was this green. There was no wick here or shadow, but it was just entirely green. But after it got to this point, it retraced lower, and when it got to this point, that's when time was up, the minute was up, so it automatically closed at this level, leaving this shadow showing that once upon a time it was fully green to the maximum level, but did not close at the maximum level of its bullish strength. And we move on to the case for the red candlesticks. red candlesticks are just the opposite of the green ones. Red candlesticks, on the other hand, close at the no, they don't close, they open at the maximum point that the previous green candlestick closed at. They open at that price. After opening at that price, if the price of the instrument that is being traded, or the currency pair, let's say the currency pair, which is the United States dollar against the South African rand. Now, if the price of the dollar drops against the South African rand, we will see that by the next candlestick on the second minute. So on the first minute, we had South African rand losing value while seeing the dollar appreciating value. That's why we had a candlestick that opened at this low price, went up, further up, and came back down here and closed. After it closes on the second minute, if the market doesn't continue going up, meaning creating another green candlestick, if it decides to instead lose value, if the US dollar loses value, we will see a red candlestick open at that price whereby the previous candlestick closed at. And if it goes down, it starts becoming red, and it will be for its red for the entire duration of it losing value or dropping in value. So if it starts losing value from this point and goes down, 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 down to this level, and we say this is entirely red. If it loses value to this level, but before the minute is over, it starts gaining some value, we will see a trace of its shadow. We will see a trace of its shadow a bit longer, saying that once upon a time, within a minute, we were here. The dollar has lost value to this level, but picked up some momentum and went back. And if the minute expires at this level, we will see the candlestick close. And the next candlestick has to open right where the previous one closed. But we don't know what color it is going to be. So if the next candlestick is going to open here, we can just say, oh, here. If it is going to appreciate in value, it will go up and turn green. But if it is not going to appreciate in value, still open at this price and go lower and go lower and go lower. And this is how candlesticks form in order to show us the opening price and the closing price per minute, or per 5 minutes, per hour, per 4 hours, depending on what time frame you're looking at. So now let us look at live examples of this happening. Okay, let us go back to so here, this is representation of candlesticks. These are candlesticks, all of them. Let me show you what I mean when I say all of them. So if you look here, we have this red candlesticks here. You see, this is a candlestick. It is red, red, green, green, red, green, green. But all of these are candlesticks. They show us where the price is going, what is going up, or what is going down. So if we look at let us take for instance this large green candlestick. See this one. and let us analyze it the way we discussed. So this candlestick, it opened at this price down here. This was the opening price of this candlestick. It opened and went lower to this level, meaning that it was once a red candlestick, but before its expiry time came, it went up and went above the opening price all the way up to this level up here. But before its time was up for it to expire, it came down, and by the time it expired, it closed here. So this was the closing price of this candlestick, and this means that the next candlestick, a green one, opened right where the green one closed. It opened down here, went down, went above the opening price, went up. When it got to this level, it started dropping, and this was the maximum level it reached. But by the time it closed, the close was right here. The same applies for the next one, and we have the red ones here, which means that when this one closed up here, this one opened right here. So that's why it opened. Let me make this a bit larger so we can see it. So this is where this red one opened. It went up, and from this point it started going down, went level with the price that it had opened at, but instead it went lower. After it went lower, it went a bit lower because you can see we have a small shadow here, but when time was up, it closed down here. So it opened up here, went up, went down. By the time it reached this level, this is where it closed. It started closing. So let's see. So this is exactly how candlesticks, this is how we do candlesticks: opening price, closing price, opening price, closing price. If it's a candlestick that is green in color and shows appreciation of value, if it's a red candlestick showing depreciation of value, then it will have a closing price down here and an opening price up there. All right, so now that we've talked about candlesticks, so we see many candlesticks here. Now this entire data here that you see, all these many candlesticks, they were created within, let me do this. So we have this candlestick, this one, this one, this one, this one. All these candlesticks were created. Each one of them took an hour to be created. See where my pointer is? When I click it, it says 1 hour. This means that it took an hour to create this candlestick. It took the next hour to create this one, the next hour to create this one. So this is a time frame of candlesticks that were created, each candlestick being created for an hour. So no candlestick was created for less than an hour. All of them were created. It took an hour to create each candlestick. So since we talked about all these different time frames, so when I open this time frame here, it's a 1 minute time frame. And what does it say? It says that every candlestick you see, this one, this one, this one, the small one, small, big, small, all these candlesticks, each one of them took a minute to be created. So it took a minute to create each candlestick. So we access these candlesticks by using our trading platforms, and this whole platform that you see that I'm using, that is giving me all this data, it is just what we call tradingview.com, which is up here. So if you go to tradingview.com and choose charts, you will have charts being displayed to you in an auto candlestick form. Okay, so yes, and you can choose what time frame you want to see the candlesticks at. So if you want to see candlesticks that are created every 5 minutes, you just switch to 5 minutes. But don't worry, later we are going to talk about trading platforms, how they help us and everything. So do not worry about where you get these trading platforms and everything, because it will be discussed as time goes. So when I open this 5-minute time frame, it shows so many candlesticks that were created 5 minutes per candlestick. So this one took 5 minutes, 5 minutes, 5 minutes, 5 minutes, 5 minutes, 5 minutes. Basically all of them took 5 minutes. And if I switch on to another time frame, let's go to a larger one, 1 hour. Okay, we were on the 1 hour time frame. Let us go to daily time frame, meaning 1 day. So when you go to a daily time frame, this is whereby we say every candlestick that you see took an entire day to create. So this red large candlestick that you see here, it took an entire day to be created. So is this one, the next one, the next one. So between this 1, 2, 3, 4 candlestick, we are talking about 4 candlestick that were created between 4 days. Yes, it took 4 days to create this one, day 1, day 2, day 3, and day 4. So it took 4 days to create these 4 candlesticks. So if we are saying from here to here, we have 100 candlesticks, 1, 2, 3, 4, 4. If we say we will count all the way up to 100, what are we saying? We are saying that every candlestick on this 1 day time frame or daily time frame means it took 100 days to create each and every single candlestick. All right, so we move on to the next subject of interest, still on the candlesticks. So candlesticks that are green, they are called bullish candlesticks. So if a candlestick is green in color, like this one, if it's green, then we say it is bullish. Then we say it is simply bullish, from the word bulls, the animal bull. So we say it is a bullish candlestick, and the more it goes up, the more we say it is very bullish. If it becomes significantly large, we'll say that's a very bullish candlestick. But if it's just small but green in color, we'll just say, well, that's a bullish candlestick because it's green. For the red one, we say it is bearish candlestick. This red candlestick, it is bearish. It is bearish. It is bearish. It is bearish, from bears, the animal bear. It is bearish if it is red. So at any given moment, if a candlestick it is going up, we are saying it is going into a bullish movement. It is having a bullish movement. And whenever we say candlestick being formed and going down, we are saying it is going bearish. So these are the only two types of candlestick. We don't have any other type of candlestick. In terms of color, we don't have the third candlestick, but instead we have patterns of candlesticks. of which I will cover on the next topic. We will talk about patterns of candlesticks. If it is, let me just demonstrate here. If we have it being this large and the next one becomes this small, what does this mean? What does it mean for us traders if we have two candlesticks, a red one followed by a green one? What does this mean? But for now, let us just stick to identifying and knowing where the candlestick opens, closes, and its name, which is bullish if it is green, bearish if it is red. So let us go back to one of our topics. So we discussed candlesticks now, so I'm pretty much sure right now you know what a candlestick is. All right, but before we move on to the next one, you see we have all these many candlesticks. We have a bullish one, a bearish one, a bearish one, a bullish one, a bearish one, bearish, bearish, bullish, bearish, bullish, 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 bearish. So if it's going up like this green one, remember it opens down here and closes up here, meaning it was going up the entire time it took for it to be formed until the expiry time came. It was bullish, it closed here. For a bearish one, it opens right up here, goes down and down and down and comes up a little bit and closes here. But because for the majority of the time it went down and it closed below the opening price, we are saying it is bearish. But if a candlestick opens at a price and closes above the price that it opened at, then it is a bullish candlestick. Okay, so now we are done with candlesticks. Well, we will visit them another time when we get into more candlestick topics, but for now let us talk about different type of instruments or representation used in order to show price data. Right, let's see. Okay, let's open a new. Okay, so apart from candlesticks, we have line charts. Line charts, I think you are very familiar with those. So if we have our y and x-axis here, and we have price 1, 2, if it's dollars, $1, $2, $3, and down here we have days, 1 day, 2 days, 3 days. We have line charts. Line charts are simply a line chart. It's just simply a type of a chart that instead of having candlesticks like this one showing us price data, okay, instead of this ones we have a line that shows us price. So if the line is here, it means that at this particular time the price of this currency pair is 1. If the line goes down, it means it's 50 cents. If it goes up, it is $2, 1.5, 3, 4, depending on what is influencing the price to go up or down. So for a line chart, we simply have a line to show us price. Nothing complicated. It's just a line. This line shows us the price for that particular currency pair at any given moment. So what price does, which makes it have a relationship with a candlestick, is that for a line to be formed, we are going to take every closing price, okay, every closing price. So if this candlestick opens here, down here, you see there's let me enlarge and so that we can have a better view of what we're talking about. I want you to see exactly how a line chart forms, for us to have a line which is steep or ranging or in any direction that it picks. So a line chart forms by taking every closing price and connecting them together. So if we have a bullish candlestick, remember, for a bullish candlestick to form, it opens on a low, it opens lower, and it closes higher. So if it closes up here, so if that's where it closes, it opens here and closes here. The next one opens right here and closes up here, and this is a very small candlestick. And for a bearish one, it opens up here and closes down here. No, not there, but up here. So is this one, which opens up here and closes down here. The way the line is going to be connected is by taking every closing price. So if this closing price here was at 15 rands, we're going to have a line that will go this way. Okay, let me do this. I seem to be having a hard time drawing this thing. Maybe it's because I zoomed it way too far. Okay, so if this candlestick closes here and this one closes here, the red one closes down here, this becomes a line, and closes here, here, close, 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 close. Okay, so you can pretty much see how I'm creating this line out of the closing price of every candlestick. So this is how a line chart becomes to be, by connecting every closing price per minute, per day, per hour, just like every candlestick. Okay, so if we go back here, we are saying that if we are in on a 1 minute time frame, meaning that every minute we have opening price and closing price. So if the closing price is 1 at this minute, we'll have a line like this. On the next minute, the closing price is lower, the line goes this way. The next minute, the price skyrockets really high, all the way to, let's say, 7. The line will go straight to 7, and if the price at that particular minute it closes at that price, we'll have the line up there as a close. And if this chart, the candlestick that opens next, closes all the way down to $2, the line will go down. And if for the next minute it closes maybe in a range between 2, 3, so let's say now minute 4 closes here, minute 5 here, minute 6 here, minute 7 here, minute 8, 9, 10 minutes, 11 minutes, and for the next minute closing price is higher, it will do this. So basically, for a line chart, this is what happens. The line is just connecting the closing prices per minute if you're looking at a 1 minute time frame, per 5 minutes if you're looking at a 5 minute time frame, per hour if you're looking at a 1 hour time frame. Okay, so remember, when I talk about time frames, I'm talking about here it's just time frames. It is just a window, like when you open a window or a tab. If this is the tab that I've opened, if I click here, I open this new tab, it's the same thing. If I open this new tab, I can call this tab a 1 day tab, and this tab is a 1 minute tab. So similarly, on our trading platforms, we can access candlesticks or the line on different tabs. So since this right here it's day, it means we're on the tab of the 1 day time frame, meaning every candlestick took a day to form. So I open this window and I click the 1 minute tab, and my trading platform quickly switches to the 1 minute time frame or the 1 minute tab, meaning here I get to see exactly what happens every single minute, every single candlestick. Okay, bearish, I get to see the whole picture. So now let us switch on to the line chart so that you can see that the representation will not be that different. So you see it's bars. Okay, we have others, but all these others are not that important. Line. So if you switch on to line, you can see we still have the same range, because remember the line chart, it just connects the closing prices and creates an entire chart out of that. So this is how a line chart looks like from a 1 minute perspective. Let us switch on to another tab, 5 minutes. Okay, it looks differently. So you see, this is how it looks like, the line chart from the 5 minute perspective. You can switch back, you're still going to see the same range. See, candlesticks, go back, line, no different, candlestick, line. You see? So for the third type of candlestick that we have, it's simply the bar chart. These are the top 3 commonly known. So the bar chart looks a little bit more ugly. I don't use this one myself. I do not use bar charts because I just don't like bar charts. The bar chart is not it's not so easy to read. As you can see, it is just doesn't look good at all. But similarly, for a bar chart, we still have opening price and closing price. So I think a bar chart, unlike the line and the candlestick, it pretty much shows you exactly where it opened and where it closed by this small lines on this side and this one by this side. So what you're saying is, for a line, not for a bar to form, we have to have price. If we are talking, let's talk about a bearish candlestick. A bearish candlestick is a candlestick that is going to be red at the end of the day. So if price is right here and the candlestick goes bearish and goes up and leaves a shadow or a wick and closes down here after the duration is over, this will be how the bar would look like. Opens here, goes down, closes here. If the next bar, it is going to be a bullish one, which symbolizes an appreciation in value, it will show this line. And if it goes down before eventually going up, okay, it will do this, go down. And if appreciation starts to kick in, to go up. If it gets rejected up here, meaning no more further appreciation, okay, no problem, it goes down. And if when the time comes for it to expire, it closes here, this is how the bar will look like. So all these bars that you see here, they were constructed the same way candlesticks were constructed, just that for the bar chart we have it looking this way, which is way less attractive than candlesticks and line charts. So this is the 1 hour time frame that shows us every bar that was constructed within 1 hour. So see, we're on the 1 hour window. So this means that this bar here, it took a minute, not a minute, sorry, it took an hour to form this bar, an hour to form this one, an hour. So these are the 3 different types of the indicators that we use in order to see price. Okay, opening of a price and closing of a price. So if you can see, for this bar here, the most recent bar, it has this line here and this, okay, entire body of it, and this line here that shows that it opened here, went up, down, and stopped here. If you can see on this axis here, we have these different prices: 1.35805, 1.3590, 36, all the way up. This is the side that shows us price per every movement. So if I put my cursor here and I say that this bar was going up, just look at how price is changing. You see 1.3586, 88, 89, 90. See, price is moving every time this thing is getting constructed. So if it closes here, this means that this was the closing price of it, which was 1.3581, 1.35809. So if when the market opens, we'll get to have a new bar that will start right at this price. If it goes down, similarly, see price how it goes down, and if it closes here, we will say it had closed at 1.35538 for that bar. Or if we're looking at candlesticks, it's the same thing. Price is always the same. If this candlestick opened here, went up and created this shadow, then when below its opening price and closed here, still opened at the same price. And for the line chart, we have the same thing. Well, but for the line chart, as you can see, it is not so easy to see where the closing prices, where we can find the closing prices, because it's just a line, so we cannot see it opened here and closed here, but it's just a line. It connects all those lows, all those closing prices, but it's not so easy to read it. But for presentation, it is quite simple and easy to see what is happening, so you can get to see the direction, because the line is much easier to read than, I guess, the other two. But as we go on to the next topics, we will talk about why the Japanese candlesticks ended up being widely used instead of lines and bars. But in honest fact, we can talk about that right now. This is because candlesticks, they are just easy to read. You can see a lot of information when you look at them. If you look at every single individual candlestick, you can see that, okay, so if it's bullish, it means it opened down here, it closed here, and once it was right here, went down. So the Japanese candlesticks, they just show more data. They are easy to read. They are not unattractive to the eye, and they are not like a line. Like if you look at a line, you don't get to see open, weak, shadow. But if you look at bars are not that good looking either. And if you're somebody who uses glasses, you may not actually see what is happening here. But if you look at the candlesticks, you just get to see clearly in a better way, and they get to show us like the psychology of this candlestick when it was opening. For example, we can create a story using this one candlestick. Let me show you why candlesticks remain everybody's favorite. If you look at this candlestick, you can just say, okay, this one. You can just say, okay, if it ended up a bullish candlestick, it means it opened here. When it opened here, buyers, meaning those who buy the market, they bought this currency pair from this level, kept on buying and buying and buying, and pushed it all the way up here. When they got to this level here, they started getting nervous and said, no, we don't believe that this thing can still go up, so let us stop buying. And when they stopped buying here, the sellers came in and pushed it lower and lower, and by the time it got here, that was when an hour elapsed, like time for an hour, because this candlestick was created within an hour, because we're on a 1 hour window. So when the hour elapsed, then this candlestick closed right here. So you can get to create stories looking at candlesticks and say, okay, investors wanted to push it down, they wanted to push it lower than the opening price, but they ended up changing their minds and saying this market is going to go up instead, and you see, so on and so forth. The same thing you can do with a bearish candlestick, but overall candlesticks remain favorites to every trader out here. So with that said, let me conclude our lessons today, and thank you for viewing this long video, and I hope everything was clear, and if not clear, feel free to ask me anything. And thank you. See you on the next video.